Hey there, and welcome to Real Investment News. I'm Mike O'Neill. This morning I want to talk again about the housing market. Now, last week we told you how there was a big 9.7% jump in new residential housing starts and how existing home sales in 2017 hit its highest number in more than a decade, and building permits, the indicator of future construction, rose 7.4% January, which is good because there's a shortage of inventory out there, which is actually driving up prices. And while most of that sounds positive, Lance Roberts, chief editor for Real Investment Advice, just asked this question in his new article, Housing Recovery or Another Fed-Driven Inflation? Now, one of the first things he talks about is prices, and this chart may actually look a little overwhelming, but here's what you need to know. These areas from the purple down, these are the sales of new homes that cost $299,000 and less. This is the range available for about 80% of income and wage earners. But see what happens after 2011? New home sales for those in the bottom 80% are dropping, while those in the top 20% are actually increasing. Now, even more surprising, how many housing units are vacant? You would think that during a real housing recovery that the vacancy rate would be falling, but instead it's right around 5.4%, just half a percentage point from those all-time highs. Maybe it's because a lot of them are being held for rental properties. It's possible. When you look at the drop in the percent of homes that are actually being used for ownership, that probably explains it. Now, there is a little bit of an uptick here. Lance believes that this may be because real estate investors are selling their inventory, thanks in part to a rise in mortgage rates, which could climb even higher if the Feds raise their interest rates. But considering that wages are essentially stagnant, people are relying on debt more and more. You can see how after the housing collapse, home ownership rates have taken a dive. We saw that before, but debt continues to climb. And that explains this flip between the number of owners, as you can see here, and those who are renting. Now, this is a vicious cycle. Investors buy homes with the intent of using them for rentals. That drives up home prices, making them unaffordable to most Americans, meaning they have to rent, and so it goes. So the real question is, are the powers that be paying attention? The risk to the housing recovery story remains in the Fed's ability to continue to keep interest rates suppressed. Every tick higher in mortgage rates reduces a person's ability to make their monthly payments. Now, I know that there's a lot to look at here, but you can read Lance's thoughts and take a closer look at these charts at realinvestmentadvice.com. But until then, thank you very much for watching. Be sure to follow us on Facebook, Twitter, YouTube. Check out our past reports on realinvestmentnews.com. I'm Mike O'Neill, and we'll see you again in a couple of hours.